Now it may sound technical, but actually it's rather simple in the end. Now the macroprudential perspective, which is the way in which regulation supervision was structured before the macroprudential frameworks were put in place, was very much focused on the considering the strength of financial institutions taken on a standalone basis, in isolation from the rest of the financial system. So how much capital does one institution have in relation to the risk that it incurs? What is the nature of the counterparties to which it's lending? The macroprudential perspective, on the other hand, considers the institution only in relation to the system as a whole. It focuses on the stability of the financial system as a whole. And once you do that, if you look at the wood as opposed to the trees, if you like, it becomes natural for you to think of the relationship between the state of the financial system and the state of the macroeconomy, those macroeconomic fluctuations that I was telling you about. And there you have two questions. One is to what extent the financial sector as a whole can deal with a blow like a recession or a big capital outflow, if that happens. And also to what extent the financial system itself can generate the shock in the first place by contributing to the buildup of the financial imbalances, by providing too much credit, by increasing asset prices too much during the expansions until you get a natural contraction. So most of the macroprudential tools relate the state of the financial system to the state of the economy, to the global, or if you like, aggregate financial developments. So countercyclical capital buffers basically say that you should tighten buffers in good times, the minimum requirements, and you should loosen them when problems arise. Minimum loan-to-value ratios, minimum debt-to-income ratios, which are supposed to try and constrain the buildup of financial problems, typically in the real estate sector, but not only.